Mark, it's good to see you. And first of all, I didn't know prior to this that we have weekly refinancings, basically repricings, I'm trying to say, of these bonds. I mean, that's a huge problem if you have yields spike. So how bad is it out there in the muni market?
Yeah, good to speak with you. So obviously, look, the muni market has felt some pain here, as all markets have felt some pain. Variable rate demand notes, short end of the market, where municipalities, hospitals, school districts, universities borrow, those rates have really spiked, as those are puttable bonds on a weekly basis, and dealers have had to take them on to the balance sheet. We are getting some Fed relief now. The Federal Reserve is going to take on some of these variable rate demand notes from money market funds. That is already showing a little bit of relief at dealer balance sheets, but it's going to take some time to really flow through. We had rates as high as 7-8% on some of these weeklies and dailies. They've come down a little bit now. It'll probably take a few more weeks to factor out, but very expensive short-term borrowing for municipalities.
And like you said, even for some hospital systems, which have a double whammy right now. So if you all of a sudden have this debt trading at 7 or 8%, how much is this? Who's most exposed? Is this usually a small portion of any municipality's portfolio, or is it 100% for some and 0 for others?
No, it's usually a smaller part of the portfolio. The market's a lockdown right now. It's very hard to do new issuance with all the disconnection in the marketplace. The muni market has had a big sell-off. We've seen a lot of redemptions from the retail investor. 70% of our universe is the retail investor through either ETFs, mutual funds, or individual purchases. So, in the short run, a week or two or even a month won't really hurt the balance sheets that much. There's two problems here. Obviously, the cost of borrowing for the issuer of hospitals, as you said, school districts, but also the fact that having these short-term instruments on the books by the dealers kind of gums up the wheels of the system, and it hurts for dealers taking on longer-term bonds and stocking bonds and creating liquidity in the longer end of the marketplace.
Absolutely. So for the cities and states themselves, look, the other troubling piece of this is that the plunge in yields and to some extent stocks is going to hurt their balance sheets as well. So you have the balance sheets getting worse, potentially dealing with costs related to population sick because of coronavirus, all of their tax revenue in jeopardy because of the economic shutdown, and now this inability to kind of access funding on the markets. How long can the situation persist?
Well, look, we know that this is going to be a longer-term situation. However, I think you got to think about the essential services that are available in the municipal bond market. We're still going to use our water and sewer system, for instance, while we're all home. There are large cash balances at general obligation. Issuers do have large rainy day funds. There is large days cash on hand at the toll road authorities and at the airports. We're going to have to watch this on an issuer by issuer, sector by sector basis. Hopefully, a lot of these issuers will get some federal relief in cash as well. But we feel like the muni market fundamentally was in a very good place going into this. Yes, we certainly have a question about how long this is going to last, but the essentiality of the services, I believe, will help the Fed, hopefully the federal government, hopefully help a lot of these issuers, and the fact that they've been pretty solvent and pretty strong going into this crisis should help as well. Obviously, some things we got to worry about on individual issuers, but remember that the municipal bond market is a lot more collateralized than the credit market. A revenue bond, has that added factor of maybe a mortgage on a facility, a mortgage on a building, the hospital. You have a mortgage on the facility, so there's a lot more collateral backed in the muni market than there is in the corporate bond market. So,
final question, Mark. I actually go back to thinking about Meredith Whitney's projection after 07, 08 that we were going to have. I know, rings in the ears of the muni market. But she talks about kind of widespread bankruptcies, and that didn't happen then. Does an event like this, like coronavirus, risk being that kind of black swan that all of a sudden really puts those sort of balance sheets in fundamental jeopardy or not, do you think?
Obviously, we hope not. We really believe that, look at what local governments have been able to do recently, especially at the state level, getting money from sales tax, because now when you buy something on Amazon, you have to pay sales tax to your locality, gambling revenue, cannabis revenue. So they were really in a good spot. Certainly, you got to do really good credit research Certainly you want to make sure that the credits, even if they get downgraded, are still viable in the long run. Right now, we believe that a lot of these places have different levers to pull. Certainly, again, the federal government coming in. It's certainly something to watch and certainly a concern of investors. But the market has seen better liquidity the last few days. The market has seen a better tone the last few days as rates are really significantly cheap. If you look at high-grade municipals right now, they're 2.5 times that of the long Treasury bond. We think things have just gotten too cheap for the risk.